All right, let's talk about Friday, February 20th, 2026. What a day. I mean, this one is definitely going in the history books as one of the weirdest trading days we've seen in a long, long time. We got some absolutely terrible economic news. We're talking stagflation level bad, and the market just shrugged it off and closed deep in the green. So the big question is, what on earth just happened?
Okay, so let's just dive right into this contradiction. On one side, you've got the bearish news feed. I mean, GDP growth comes in at a measly 1.4%, a huge miss from the 2.5% everyone was expecting. Suddenly, stagflation alarms are blaring everywhere. But then you look at the other side, the actual market tape, and it's all bullish. The S&P 500, the Nasdaq, both rallied hard right into the close. It's this exact conflict that had so many traders just scratching their heads.
So to figure out why we saw all that green, we have to start with the single biggest bullish catalyst of the day. It was a landmark decision that came right out of the Supreme Court, and it totally flipped the market script. Get ready for this number, $1.4 trillion with a T. That's the estimated value of all those sweeping Trump-era tariffs that just got wiped off the books in a single moment by the court. I mean, you can think of it like a gigantic out-of-the-blue tax cut for the entire global economy, and you better believe the market reacted instantly. Now, what's really crucial here is the finality of this ruling. We're talking about a 6-3 decision. That's a decisive blow against a flagship economic policy. The court basically said the legal authority used to impose the tariffs in the first place wasn't valid. For the markets, this felt like the end of a very long and very costly trade war. And here's that reaction in real time. It's just brilliant. Within an hour of the news breaking, the tech-heavy Nasdaq shot up over 1%. You had companies like Amazon and Alphabet, which are super exposed to global supply chains, jumping 2 and 4%. Poof, just like that, those huge tariff headwinds were gone. But the celebration didn't last too long. The key thing to remember is that this whole story is far from over. The administration countered almost immediately, signing a brand new executive order to slap on a fresh 10% global tariff. So yeah, the chess match is back on. Okay, so let's shift gears to the second major story of the day, which, of course, completely contradicted all that morning optimism. Just as the market was starting to price in this wonderful, tariff-free world, we got hit with a brutal reality check on the economy. Just look at how shocking this GDP number really was. Coming off a really strong 4.4% growth in Q3, the economy just slammed on the brakes, growing at only 1.4%. I mean, it didn't just miss the 2.5% consensus, it basically fell off a cliff. Now you take that number and you combine it with core PCE inflation that's still stuck at 3%, and it forces this one dreaded word back into the conversation, stagflation. This is the Fed's absolute worst nightmare, right? An economy that's too weak to handle rate hikes, but inflation that's too hot for them to even think about rate cuts. They are completely trapped. And this really brings us to the most important question for the next few weeks. So the government's line is that the recent 43-day shutdown caused this GDP miss. But traders are asking, is that just a convenient excuse? Or are we looking at a much deeper, much more genuine slowdown in the U.S. economy? So with these two massive warring narratives, how did the market process it all? With so much uncertainty on both sides, where did the capital actually flow? Well, it ran to the ultimate safe haven, which brings us to our third huge story of the day. For the first time ever, gold absolutely smashed through the $5,000 per ounce barrier. It closed at an all-time high of $5,070. Now, this wasn't just a new high. This was the breaking of a huge psychological wall that has held the metal in check for years. And this wasn't some random spike. Nope. This was a perfect storm. You had the weak GDP data, sparking recession fears. You had geopolitical tensions flaring up with Iran and Russia doing naval exercises. Central banks, especially China, just kept on buying. And, of course, all that tariff uncertainty pushed investors toward a real hard asset. All right, so what does all this chaos actually mean for your trading strategy heading into next week? I mean, how do you even navigate a market that's being pulled in two completely opposite directions at the same time? This breaks it down perfectly. Here are the two competing arguments you need to weigh. The bulls, they're betting that the tariff removal is the bigger story, the one that really matters, and they think the Fed is still going to cut rates. But the bears, they're laser-focused on that new 10% tariff, that ugly 1.4% GDP print, and the sticky inflation that's going to keep the Fed on hold. So these are the specific battlegrounds for next week. Pay attention to these levels. For the S&P 500, holding 6,800 is absolutely critical. For the Nasdaq, the bulls have got to defend 24,700. And for gold, the huge question is whether $5,000 now becomes the new floor, with analysts already targeting 5,271 as the next potential stop. But here's a really fascinating little twist to think about. While all those big tech stocks were rallying, bullish sentiment among retail traders actually cratered to a 12-week low. Right now, only about a third of retail investors are feeling bullish. Sometimes that level of fear can be a really powerful contrarian signal.
And that brings us to the one question every single trader has to be asking themselves right now. On Friday, the market made its choice. It completely ignored the glaring economic weakness and decided to cheer the potential end of the trade war. Now the question is, can that optimism survive another full week of reality? Stay nimble out there.